The Bank of England has held interest rates at 3.75%, but that might not be the good news it seems. It may just be bad news delayed as a consequence of the Iran war. Now, to work out what happens next, the bank is looking at what is perhaps the most consequential number in economics, the oil price. Here's the price going back to October, bumping along at around $70 a barrel. The war begins. We know what happens. Up goes the oil price. You're feeling this at the petrol pump. But look, the last 24 hours, it's actually hit a peak above $126 at its highest. Let's put that on a different time frame and go back 5 years. It's higher than it was after the Russian invasion of Ukraine. Now, what happens to the oil price? The bank has said will set the path for what it has to do with interest rates. So it's set out to try and understand it better. 3 scenarios based on energy prices and draw some conclusions from that. Scenario A, this green line, the most benign picture. Oil at $110 a barrel, wishful thinking perhaps, comes down back to around $80 quite quickly and stays there. There's a second scenario, the Goldilocks scenario, a little bit higher for longer oil prices, but coming down faster. The one that's really striking is this scenario C, the worst case they set out, where oil is nearly $130 a barrel, which it got to essentially during the bank's meeting, and then it stays there for all of this year and for into the future, still much higher than it was before the war. Now, that obviously has a big impact on inflation, so they've mapped the path for inflation based on these scenarios. You'll note the blue and the green, the more mild, more benign scenarios. Under both of these, inflation climbs. We're at 3.3% at the moment. They get up to 3.6, 3.7. The really striking one, of course, is scenario C, the worst case, peaking at 6.2% and then coming down. This is a return to the kind of inflation we saw after the war in Ukraine that many households haven't recovered from. So I asked the Governor of the Bank of England, Andrew Bailey, how likely is this to actually happen?
We want to do everything we can to avoid this coming about. But let me give you it's important to say what's in that scenario. Because what's in that scenario is not just that we have oil and gas prices going up a lot, it's that they stay up. That scenario has the oil price staying above $100 a barrel till the end of next year, not just this year, next year. That's a very persistent, if you like, sort of shock. The best way to solve this problem is at the source of the problem, which is solving the issues in the Gulf, getting the energy supplies flowing again, and meaning that energy prices can come down.
Now, different paths for inflation mean different paths for interest rates. That's fundamentally the Bank of England's job. And they've set out 3 potential paths based on their scenarios. But you'll notice the most benign, the blue and the green, they imply at least 2 rate cuts this year, getting up to 4.25%. The scary line, the red line, that looks like 5.25%, the same as the peak from which, before now, the bank had been walking down after the Ukraine war. Now, the truth is that none of these are nailed on, and the reality will probably lie somewhere in between. But you can look at these paths for rates and deduce a couple of things. Prices are almost certainly going to rise. Rates are likely to follow on whatever the Bank of England does and whatever Rachel Reeves chooses to do. Perhaps the most important decisions for British households will depend on what happens in the Strait of Hormuz.